Afternoon, everybody, and thank you very much for dialing into this webinar today on the Triple Point Estate Planning Service. The rough agenda and outline for what we're going to cover today, we are going to spend about 20 to 25 minutes discussing our estate planning service. The lines are muted, so I'm afraid there are no questions available through this conference call, but if you do have any, please do pick them up with your relationship manager at Triple Point after this call. I'm really pleased to be joined by Chris Lake and Toby Furniville. Chris is head of credit and Toby is head of our leasing. I think what we're going to try and cover off today in this call in as I say, 20 odd minutes or so is starting with a little bit of our track record going back to 2006 and the unique two strategies that we run in leasing and lending, Generations and Navigator. Ultimately, what they deliver for investors in terms of uncorrelated returns that produce smooth, stable returns for investors over time. The capital protection that our leasing and lending trades offer to investors, the liquidity that a leasing and lending businesses offers investors, and ultimately by building a business over time, the diversification that we've built into those businesses, offering protection to investors, and hopefully that's what we're really going to cover off today. And I think to start, if that's okay with you, Chris, is a little bit, for those that aren't aware on the call, of who Triple Point are as a business, but also going right back to the beginning in 2006 and the kind of genesis of our leasing and lending businesses and our IHT strategies. If we could start there and just ask you to just give us a little bit of an introduction to Triple Point and that start point.
Sure. So Triple Point is a privately owned asset manager. It's been around for about 16 years. About £1.5 billion pounds under management, so pretty substantial business. Broad range of investments from equity, so VCTs and EISs, social housing, and leasing and lending funds, which is what we'll talk about today. And we raise money from private capital, from institutions, and we also manage a little bit of central government money through a heat network scheme. The generation of the genesis of the leasing and lending business, 2006, we started off with looking for a product that was non-correlated to stock markets, really low risk, reasonably steady returns, but not high returns, and that started really with a leasing product focused on the NHS and local authorities. So we now have a leasing book of about 100 million, focused on examples we'll come on to later, but ambulances, tipper trucks for local authorities. That has provided over the years a very solid, predictable return. And if you were to compare that, for instance, to stock markets or AIM shares or whatever, as you can see on the slides, it's a really nice, steady return. So that performed really well, and then in 2014 we launched our Navigator strategy. So our Navigator strategy is an SME focused, more SME focused than our generation strategy. So slightly higher risk, slightly higher return, and those two, as you can see on the slide, between them produce a really nice blended return of about 3.5%. Again, Navigator strategy we'll come on to in a minute about what that does. But again, performance-wise, that has hit its targets for the last 5 years really solidly and provides a nice non-correlated steady return.
So obviously, for those of you that have dialed into the webinar, you will have seen the returns going back to 2006. We've just moved the slide on to show you the performance of the two strategies and the two businesses that investors are ultimately invested into when they enter our estate planning service, Triple Point Leasing Limited. On the bottom, as you can see, right in the middle of its range between 1.5 and 2.5, as well as our Navigator trading business, which you access via our Navigator strategy. And again, you can see the return slap bang between the two. I guess demonstrating exactly what you said, right?
Absolutely. I mean, it's a predictable return, non-correlated, so it doesn't go up and down like stock markets do, and we believe a really solid risk profile. So diversified through assets, diversified through different types of borrowers.
The mechanics of a lease, right? And just in terms of delivering that back to the
mechanics of a lease, mechanics of a loan. In its simplest form, a lease, we own the asset, We have a counterparty
Yeah.
that we assess from a credit perspective. So
Yeah.
if it's a UK government or if it's a local authority, it's a pretty strong counterparty.
Yeah.
They agree to pay us a set amount every quarter for the use of that asset.
Yeah.
And at the end, they have to return the asset in a certain set condition, or they extend the lease, which we may well agree to. So what you're getting is regular amounts of repayment for the use of that asset. Loan, very similar principle. Our loans are always generally senior secured loans, but you lend somebody some money and they pay it back over time in nice regular amounts,
and obviously
with a yield.
That cash flow transmits back to, as I said, from different counterparties, different loans,
Yep.
different leases, different terms across a broad book, gives you that predictable cash flow, which transmits to the share price that you see.
That's exactly right, and it gives us, it's not a big bullet portfolio, so it's not you're getting nice regular cash back, which means the underlying loans are reasonably liquid, and we nice steady return.
How much of the book do you think turns to cash each year? Sorry, just picking up on that point you mentioned too, for both TPL, L, and also NTL.
So broadly speaking, the leases in TPL in the generation strategy are average 3 to 4 years.
Yeah.
So you're probably getting your cash back 20% a year probably,
Okay.
coming back and recycling. On the Navigator side, the maximum term again tends to be 5 years, and normally amortising, I would say the average is probably over 4 years. So very similar profile.
Very
so
similar
we're
profile.
not taking very long-term risk, and we're not taking bullet risk where all the capital comes back at the end largely.
I guess for 2 points, obviously for investors, for liquidity profile, obviously conscious about, well, how do we give people access to those businesses, knowing that there is liquidity within the businesses from the underlying loans, I think is an important element, but also obviously inflation proofing it and interest rate proofing it. The book obviously writes at prevailing rates.
Yeah,
right?
absolutely correct. It's always at prevailing rates, and you can see on the slide there we've given a breakdown of what the underlying investments are in each of the strategies, so you can get a sense of what's in each. So on the right hand side, generation strategy, you see a big focus on NHS, big focus on central and government, which is what I was talking about.
Yeah.
Small amount of SME, small amount of housing association, and then a corporate leasing book as well, which is generally investment grade, goods quality corporates.
And I don't want to delve into the nitty gritty of these numbers too much, but I think again it comes back to, I guess, why that is important to investors. What does that deliver in terms of building up businesses that have that makeup and look? And I think it comes back to my original point about diversity.
Definitely.
And I'm going to bring you in a second, Toby, because you frankly hogged the limelight for the past 5 minutes. I think it's Toby's turn to speak. But focusing in specifically around Navigator and the business that we've built there, and the tens of thousands of businesses that we support all across the UK, the diversity that we've built into it is absolutely phenomenal. Different sectors, different businesses, and all the lease and loan terms that we talk about. How on earth do you go about finding those opportunities? I mean, we've got the high street, which investors love, because it allows them to relate to their assets, which I think is really, really important. But I mean, are you up and down the high street peddling? Where are we finding our opportunities from?
I mean, so we have an experienced lending team here in the office in London. That experienced lending team likes to get out and about, and will travel to where good business is found. But really, the starting point for us is a strong introducer base across the country, which encompasses accountants, lawyers, corporate finance firms that are plugged into their local business communities wherever they are up and down the country. And we have a good relationship with 70, 80 of those across the UK, from north to south, east to west, and they are interacting with the local business communities, understanding what businesses need, and when a business requirement they become aware of for some debt funding or some lease funding to support their growth. They are aware of Triple Point's service and will bring an opportunity to us for our team here to analyse, and we will We will do our introducer base will be the first stage of filtering for us, so they will understand our risk appetite, they will filter out those that we're unlikely to do, and then the team here, all experienced lenders, will then start an analysis process. But that introducer base is a real asset of ours, but it allows us to access a real range of business types across the high street. And, we use the high street as an example, but we see all sorts of business sectors, geographies, and that gives the investors a great access to diversification.
And I think the other point of that introducer network, again bringing it back to the investor, is around deployment and around our speed of deployment, and obviously making sure that we aren't allocated on too much cash, and that we can obviously deploy funds on a timely basis.
It means we have a regular inflow of deals, opportunities. We'll see 5, 6, 7, 8 new deals a week. We have a fairly, and Chris will talk about it I'm sure, a fairly ruthless and rigorous approach to assessment. So we're not going to do every deal that comes to us, but that introducer base makes sure we have a constant conveyor belt of opportunities for us to assess, and we will convert 12-13% of them because we're going to be rigorous with our assessment. But it means we've got access to deal flow, which allows us to deploy cash and not sit on it.
And I know we are going to touch on a couple of deals shortly, but another thing that I think obviously investors really like about the estate planning service, and something that I constantly get feedback around, is the fact that A, the assets are tangible, B, people interact with them almost daily without even knowing it. The tens of thousands of assets from, I don't know how many credit card terminals we've got in our book, but
thousands. I mean, and that's a really good point. Is we've got the introducer base for the bigger loans. We've also got agreements with partners that are originating kind of small micro loans for us. So the credit card terminal business, you do an average loan size of about £800 to SMEs. Thousands of SMEs up and tens of thousands of SMEs up and down the country. And obviously we don't underwrite each one of those in house, but we have really good relationships with partners that have a track record over a number of years that can find the opportunities, filter the opportunities for us, and we underwrite. And we have 2 or 3 of those kind of relationships.
And built investor protections in there. Again, I guess we look at the business critical element of ambulances and some of the key big assets that we started with when back in 2006. But the credit card terminals, again, as an example, is a absolutely fundamental business critical asset for people, right?
Absolutely. When our focus is always on senior secured loans with a business critical asset, or a really well established business that's really profitable and generates cash. So we're always looking at the strength of the underlying credit. So be that, it will come on to examples, but property development, be that a credit card terminal, be that an established SME, we are always focusing on key credit criteria. And Toby's right, we do have a very thorough credit assessment process. So I wouldn't want anybody to think that we're just taking any old opportunity off the street and putting it on the books. No. We are taking a very thorough approach.
We've got a number of slides in the deck that we can pull out here. I'm going to pick on a couple. We've got 4 in the presentation in total, but I'm going to pick on 2 in particular, and one from our generation strategy and one from our Navigator strategy. And just picking on the first one, which is around the deal that we've done for a number of ambulances. And it'd just be good to talk a little bit around this in terms of what I know we talked about the mechanics of it, but at the beginning in general, kind of the advantages of a lease to a high grade counterparty. But if we bring it to life with this and talk about the residual values and actually what this actually looks like in real life.
So the process for a local authority or the NHS buying an ambulance is, first of all, they have to spec the ambulance. So they say, which kind of ambulance do you want? Do you
and
want
that's them doing it.
That's them doing that. Do they want a Fiat one? Do they want a Mercedes one? Or whatever it may be. Once they've specified the ambulance they like, they have to go through a government tender process. So it goes onto a tender website, of which Triple Point is on that tender process.
And why are we providing finance for ambulances? Why aren't they just buying those themselves?
The lease finance tends to be a very efficient way for the UK government to fund things, rather than the debt sitting on the government balance sheet. It's a lease, and we're managing the asset. Why is Triple Point on the tender process? We've actually had to work quite hard to get on the tender panel at the start. We're competing against German banks, Dutch banks, very few UK lessors. In fact, Triple Point is the largest single lessor to the NHS in the UK. So once this is tendered and once it's on the site, we effectively bid and we say, this is the assets. we will provide you the lease agreement at this price with this residual value.
Yeah.
And what's meant by residual value is how much value do we think the ambulance is going to be worth at the end of the lease period. And one of the advantages we have is we have a very experienced team here who have looked at residual values over years and years, have an awful lot of data about behavioural data, how likely is an NHS to extend, and also we have an asset management team here who are very experienced and can take the assets and actually realise them. So quite a lot goes on to what on the face of it would be a reasonably simple, it's an ambulance to the NHS, but it does provide a really solid return and really the foundation that everything else is built off.
I read somewhere in some of our literature something like over 700 ambulances that we've had out on lease over.
Yeah, ambulances. We have an awful lot of ambulances. We have tipper trucks to local authorities. All kinds of assets that either the NHS or local authorities would need. We will provide on lease.
And I think that, as you will have seen from the graph at the very beginning, is how it translates through to quarter-on-quarter returns that have been completely uncorrelated to the wider markets, as seen in our original graph. And I think I'm right in saying we haven't to date had a default across that portfolio.
We haven't. I mean, the UK government is, I think, safe to say, pretty good.
As Ova said, as
pretty
expected.
Good. Absolutely.
Conscious on time and making sure that we keep to my agenda of making this a snappy 20-minute webinar. Toby, if I can just pick on you with regards to a second deal around Navigator and specifically around our secured lending book, and just talk us through this and what makes it an attractive deal, not just from your perspective, but why investors would see this as attractive.
Sure. Well, again, in this example we've pulled out here a service provider to the air ambulance charity. This business was founded 12 years ago, so it's got a 12-year track record of establishing its services to the charity, and over that time it's built its revenues from scratch to it now delivering £9-10 million worth of revenue per annum. It generates £3.5 to £4 million of operating profit and £3 million of net profit. So that demonstrates to us that the technology it provides to the air ambulance charity is mission critical. Mm-hmm. So again, different to a tangible asset being mission critical, but equally a mission critical asset. And they've got a proven track record that generates revenues, profits, and most importantly cash. Because back to Chris's point, whilst it's a loan is different to a lease, it's not the same profile where we have provided capital to support this business, and they will pay us on a quarterly basis, capital and interest over the next 4 years. And I think in this case they've made an early repayment of a sort because it actually generated additional profits in the last financial year. And it goes back to it's a proven business model. It's got a mission critical asset that we've effectively funded against and the service they provide. And for our investors, it just gives them that, again, a steady income. But we're able to deliver a slightly higher return than to that sort of asset than the generation strategy. So
I think a really important point to make is traditionally, probably pre-financial crash, this type of lending would normally have been done by a high street bank. This company, I think, had a relationship bank that it tried initially to get the funding through, and after a reasonably long period, they decided not to fund. But
why is that? Why are the banks, especially given, we've heard countless conversations about one nation conservatism, levelling up, unlocking capital. But why do we see this kind of, constriction around getting capital into businesses, especially out in the regions that need it?
I think we could probably talk about 25 minutes on that question alone, to be honest with you.
No, I don't want
but I think in a nutshell, the point I would get across is this is certainly not a risk that the banks won't take. It's not. I wouldn't want anyone to get the impression that we're taking a riskier approach. Banks it's much more to do with their structural problems around capital allocation. There's been a bit of a brain drain in the banks, I think, and their capacity to deal with relatively small SMEs really is not what it used to be. And we can maybe have a separate webinar on that.
I don't want to go into too much detail.
But the key message for investors, I think, is it's not a risk that banks wouldn't traditionally have taken.
Okay. I am conscious on time, but I would like to just pick out on one more Navigator deal around the secured property finance stuff, only really to illustrate the fact that the Navigator business is incredibly diverse, and I think that's what I really want people to get across, is we have a variety of different I guess lending and leasing trades that we are doing within that business, and I think that obviously is something that is important to investors because of the diversity that we're building into it. So I know that we didn't talk hugely about this trade before we moved into this, but just talking a little bit around the secured property finance stuff that we do and how that looks and why that's attractive, where we protect investors' capital, you know. Can I pull on you to?
Yeah, sure. Do you want me to that?
Yeah. Sure.
So I mean, it's exactly the same principles as what we've just talked about in the direct lending market. Is that this is providing financing to experienced developers, relatively small scale, so building anywhere between 2 and 12 homes. Traditionally, the banks would have funded this, but historically, in the last recent past, haven't. We have a team in-house here of people out and about, originating, interacting with brokers, finding opportunities, and importantly, very experienced lenders. So we only ever lend on a first charge basis. So we're always the first lender. We do a maximum 65% loan to value, so conservative loan to values, but also delivering, houses that are needed for the UK population. So really good risk profile, asset secure, relatively low loan to values. And providing a service that the economy needs. So to us that seems like sensible risk and good risk. Yeah,
it definitely does. As I said, I am conscious on time, so I'm going to miss over our final example that we have in the slide deck that you can see, and just go on to the final point, which is the next slide on, which is around diversification. Yeah, perfect. And we've obviously talked about 2 businesses today, and this is a point I'll pick up, but what we haven't really talked about is something that I think is very familiar to a lot of investors who have been in and around the business relief space, and that is obviously exposure to renewable energy assets, which is an attractive asset class. It does have a load of characteristics, but it's not something that we do within our business. And I think for everybody who is dialing in, one of the big things that we have been really prominent on talking about to investors is the importance when building business relief strategies to build something that's complementary across a number of different providers. And it's not a question of picking provider A over provider B, but it's about picking the right provider A with the right provider B, so if I can get my words right. And having our strategy that is focused around leasing and lending to a huge range of counterparties, as we've discussed today, from the NHS and local authorities, which interestingly you pointed out, we compete with the banks rather than other BR providers.
Absolutely.
All the way through to the tens of thousands of businesses that we support through our direct lending strategies, is something that is very, very unique to the business relief space, and it acts as a really nice complement to a lot of the other providers that have a focus around property bridging and around renewable energy. So for us, I think that's something that I really want to focus on when I talk to investors about. My final slide is really a wrap-up piece. I hope what we've got out of today is really a focus in and illustrating that track record that we've had going back to 2006, that demonstrable performance, quarter-on-quarter growth that's uncorrelated to the wider markets. Very kind of both of you to take the time out today, but Chris and Toby are 2 of a much larger team. I think you've got about 31 people within your team that are actively running these businesses, working for shareholders to deliver the returns, these smooth and steady returns that we've spoken about, in an uncorrelated fashion, and making sure that we protect investors' capital through it. I should actually say you're an award-winning team. I forgot to mention that. Sorry.
That's okay.
Yeah,
we'll let you off.
Yeah. Anyway, as I said, the strategies offer people the ability to pick and blend between our generations and our Navigator strategy, something that's very different from a lot of our other peer group. At this point in time, what I'm going to do is I'm going to leave it here. Just to say, if there's any follow-up questions to the webinar, if anyone needs any more literature, please do contact the relationship management team, and details should be on a slide now. If you need anything else beyond this call, if you'd like to look at illustrations or anything to do with diversification with our peer group, please do let us know. And lastly, just a huge thank you to both of you for taking the time.
Thank you.
Pleasure.
Cheers.
Thank you.
And thank you all very much for dialing in, and we'll hopefully speak to you very shortly. Cheers.
Thank you.